So let's begin by talking about the long-term upward trend that we've been in for the last decade or so. This trend shows that we've obviously been in a bull market, an upward trending market, and we just had the shortest recession on record due to COVID back in 2020. But since then, the market's gone up quite a bit. So let's take the pulse of how things are going for the largest companies in America, which are currently right in the middle of reporting third quarter earnings. So as of this recording, November 1st, 55% of the S&P has reported so far, and 81% of those companies have beaten their earnings by about 10%. It's pretty good. And as far as sales are concerned, revenues, 70% of companies have beaten their sales estimates thus far by about an average of 2%. Now, considering the number of cargo ships sitting out there in, right off of ports all over the United States, these numbers are really good. On the right-hand side of these sales numbers, you can see the consumer seems to be a little bit more challenged. Now, consumer discretionary companies would include Amazon, Home Depot, Lowe's, Target, but I don't think that's necessarily who's having the issue. I think it's more along the automobile sector, which is in that consumer discretionary place. That's Ford Motor, General Motors, et cetera. You see sales off 3.2%. Obviously, with the number of automobiles not sitting on dealer lots for sale at the moment, that's certainly going to hurt sales. So, as those areas come back online over time, you'll probably see consumer discretionary things look a little better. Industrials as well. Industrials make things, think 3M, UPS, Honeywell, General Electric, et cetera. They're off a little bit, and it's probably a lot because of materials sitting out on container ships out there in port. So when we think about what's going on economically, I mean, things are pretty good. If we look at the price of the market, we've been seeing comments in the media about markets being expensive, which, by the way, you always see those comments in upward trending markets. But what's interesting is that even though the price of stocks went up in 2020 and went up in 2021, the actual price of the S&P 500 compared to earnings of those S&P 500 companies, which we were just discussing a second ago, it's gotten cheaper. So actually, even though stocks have gone up, the market's gotten cheaper. That's not to say stocks are cheap necessarily, but it is to say they've gotten cheaper over the last 6 to 9 months. And with interest rates so low, there's nothing that says stocks just absolutely positively have to get cheaper anytime soon. If we consider prices for the future, however, one thing I will say is that the chart that we have in front of you right now basically says that looking forward, 5-year returns for stocks ought to be lower than what they have been maybe over the last decade, simply because of that current price of the market. It doesn't mean to be less invested than you are. It just means that, we may get mid-single digit kind of returns for stocks in the future, and that we ought to be satisfied with a lower number than 15 to 20% like we've seen over the past few years. Obviously, we have no idea what stocks will do over the next few years, but we do still see some reasons to be positive for sure. So one question we get asked a lot is about the housing market and if we think it's a bubble. So we do not believe the housing market is in a bubble, though what would certainly slow it down would be rising interest rates. If you look at homes over the last 50 years, before the Great Recession, on average, there were 15 million homes built per decade. And from 2010 to 2019 nationally, there were only 9.1 million homes built. So a third fewer homes built in the United States. So why'd this happen? Well, there were fewer buyers earlier in the decade after the Great Recession, and builders didn't have the money to build spec homes, and banks really weren't in the mood to lend money to builders for building spec homes. That, of course, has changed now. There are more young buyers out there, and there are lower interest rates. So that's certainly fueled the demand for housing. If there aren't enough homes in the US, but there are more qualified buyers, then by default, that pushes prices higher. How long will this go on? Our guess is until demand and supply come more to equilibrium, but we're not there yet. So that was nationally. Let's think about things more from a regional perspective. Where are people moving? If we look more regional in 2020, it looks regionally like people are moving to the Southeast and Southwest, with the exception of California. It would seem that most people in a post-pandemic time period are moving to states with lower taxes, more potential freedom to live where they'd like. The Southeast has one thing going for it that the Southwest is not, and that's more water, more natural resource. It'll be interesting to see how that impacts real estate over the next 10, 15 years. Phoenix has been the #1 growth city by population 5 years in a row. And I just can't help but wonder from a water standpoint when that becomes an equation in where folks choose to live. But even pre-COVID, you can see that, for example, the state of South Carolina was the #1 state people moved to in 2019 in the Southeast. And you can see where people are moving from. So those areas certainly that they're moving from tend to have higher taxes, and the states they're moving toward perhaps have a little bit lower taxes. I would say Washington and Oregon may be the exception to that. But the point of all this is to say that, real estate nationally, we're still in a housing shortage relative to the demand. And that's probably not going to slow down in the near run. But if you look at things regionally, it certainly seems that here in the Southeast, we're pretty well aligned to have continued demand from folks all over the country considering this as a home. And I mentioned earlier, what if interest rates do rise? What happens to prices of investments like stocks, or even real estate? I mean, again, real estate may slow down some, but people have to live somewhere, right? And if they're paying cash, obviously coming from other parts of the world, if real estate costs more elsewhere, then that ought to at least help on the demand side. But the chart we have on the screen in front of us right now deals with what if interest rates are rising. So this chart goes back 55 years and shows that historically the stock market has gone up even while interest rates are rising until the US 10-year government bond gets to roughly 4.5%. Since the Great Recession, 2008, 2009, what you've seen is stocks could rise without much of an issue until we got to around a 3.6% yield on the 10-year government bond. Those are the green dots on the screen. And what's important to note is that as of today, November 1st, the 10-year government bond yield is yielding roughly 1.6%. So obviously that's a pretty good long ways from 3.6%. All right, so we all know that inflation is with us now. And the good news is that households seem to be in the best shape to weather inflation that they've been in for the last 40 years. On the upper right-hand side of this chart, what you'll see is that the amount of money being paid by the average household toward debt on a monthly basis is at its lowest percentage in 40 years. And certainly net worth in the bottom right-hand corner, households continue to build their wealth, build their assets, and pay down their liabilities. That's a good thing. Additionally, there are 11 million jobs roughly open in the United States. And over 50% of the National Federation of Independent Businesses say that they have at least one job that they have been unable to fill. Anecdotally, we see and hear of countless jobs at $15+ an hour going unfilled. I personally have noticed here in our city, the bus system offering $1,000 signing bonus to drive the air-conditioned bus. I mean, our takeaway is the average consumer in the United States has choice and must be in reasonably okay shape to be supportive of the economy, still spending money out there. Unfortunately, gas prices are on the rise. Gas is around 2.2, 2.3% of the average household's outflows in terms of what they're spending on gas. And at the gasoline price peak back in 2014, it was around 3.25, 3.5%. The question I would ask really is gas the main thing to be concerned about? I know it's never fun to see it cost more, but gas costs the same as it did back in the fall of 2014. So we've had 0% cost increase in gas if you compare it to that time period. But in the same time period, a box of Cheerios is up 25% since 2014. A new iPhone costs 30% more than it did in 2014, and a Big Mac's about 16% higher. Certainly higher gas prices matter, and we'll need to get our mind around that, but other items are likely to be eating our wallets a bit more than gasoline is. So, overall, what do we think? Markets tend to generally react to whether things seem to be getting better or whether they're getting worse. So if you're wondering why stock prices currently seem to be going up when there's indeed inflation out there, when there's indeed rising gas prices, it's because of a strengthening global recovery. So what I have on my screen here is people's views nationally on COVID-19. COVID-19 trends are indeed improving, but with boosters, the improvement in healthcare risk could, materially get better in 2022. So what's this mean? So as you can see in this chart, the latest Pew Research poll shows 21 to 35% of Americans still view COVID-19 as a major threat. The most common concern is vaccinated versus unvaccinated. Now, we're not commenting one way or the other on that topic, but this chart says that somewhere between 1/4 and 1/3 of Americans have not resumed normal activities. That's a big buying unit of Americans. They've got a lot of money. Even if 5% of Americans, let alone global citizens, are deferring their activities due to COVID risks, and this improves in 2022, this would represent substantial incremental demand in the economy. That's a pretty big deal. We're also entering historically the strongest part of the calendar year. While we can't tell you what will happen, we do see reasons to be reasonably optimistic. All right, friends, thanks so much for watching. As always, thank you for the privilege to serve you and your family. If this brings up questions, please reach out to us. We love talking about this stuff. Talk with you soon.